Aloha. Okay, I'm finally back. I'm sorry. I totally violated my promise. I said that I was going to do these things weekly. That got to be a bit much. My bad. My bad. Aloha. Appreciate it. Hollows. Okay. So, we've got a cool question. A cool question came in, and I thought, I got to take the time to do this one. This is it's just so ridiculous. Like, okay, I'm back in Los Angeles. I'm no longer in Hawaii. It's gutting. It's gutting. It's making me cry. um, this is what you get when you marry a musician. You get a complete studio. I want to show you guys. It's awesome. She's crazy. I don't know what she's doing. This is like so much, so much, so much. I just hit something. I broke something. All right, so I've got lights on me. Lights, camera, action, and action. All right, so really cool question came in. Investing in independent films post COVID. Solid, 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 solid. Um, there's a lot of people. There's a lot of investors that I know who get into the film industry, and it's kind of like a pastime. There's a lot of people, I mean, shit, myself included. It's like you get into, kind of speculative investments in the film market. If you know the market, yeah, you can dabble. You don't have to be all in. You can play around with a lot of things. And film is no different. And what I think is interesting is that film is really scary for a lot of investors because there's a lot of shit talking. It's kind of like, oh, it's dangerous and everybody loses their ass and you don't make your money back, let alone get profits. Well, that's definitely not the case. It's not the case before COVID. It's not the case after COVID. I think the major difference for COVID is that it created a hunger. So you've got a lot of crew, you've got a lot of cast that are wanting to work, and they haven't been working for a while, and so you may be able to get some deals out there, whether it's on their upfront pay or it's on their terms. I don't want to create enemies out of the agencies that I do business with, so I'm not going to go into detail. But bottom line is, people want to work, and the agents want their clients to work. So at the end of the day, it's a win-win. So there are some deals to be had in terms of packaging your talent, packaging your above the line crew. It's a good time. As an investor, if you're looking at a project, I would say it's not too dissimilar than what it was pre-COVID. So if this is something that you're dabbling in, and I understand that, if you're dabbling in it pre-COVID, don't treat post-COVID any different than you used to. It's going to be just as scrutinizing. The buyers have not been suffocated. I know that there's a lot of talk about, oh, well, there was a shutdown, and so there's this like major slowdown in product being created. Yes, that's true. But at the same time, there were a lot of buyers, studio level and mid level, that I know for a fact were buying a lot of content and padding their calendars. So they're not wanting for content at all. There are some studio level buyers that I know have their home video calendar booked well into 2022. So don't think that just because you're throwing a bunch of money into a really good production value project that you're going to see some massive return. These are not NFTs. This is not Bitcoin. It's a different animal. It's a longer haul, but it doesn't always have to be. So here's what I want to say. For all of because the gentleman, our pal who asked the question, he's not an investor, he's a filmmaker, but I want to give this answer to the filmmakers. For the investors who are accustomed to investing in films in an equity position, so you're early in and you are really kind of banking on the overall success of the picture, it's the same world. Nothing's changed. Okay? The alternative. We're in an interesting time right now. Yes, there were a lot of films that went into production during COVID. You're talking probably about a third of what would have been produced the previous year, vis-a-vis. But what's interesting is you've got a lot of films that went into production with X amount of funds, and they just kind of were gunslinging, and they figured, well, we're going to get as far into production as we can without spending any more money. And so you've got a good number of projects that are requiring finishing funds. That's an interesting position to be in. So finishing funds, if you can come across a really strong project, especially if it's got some name talent involved, then you're in a position where you can argue for a senior debt loan. And I don't, I'm going to give information. This is not a favor to the investors, but this is also just information to the filmmakers. If you're looking for debt financing, it means that you hit a bad spot. It means that you're a quote unquote distressed asset. And so anybody who's going to bail you out and they're going to provide the funds that get you across the finish line, they're going to charge a pretty penny. And a lot of the companies out there that do this religiously, like as a part of their business model, they're going to charge anywhere from 20 to 25% is what will be calculated. They might say it's like, oh, it's an 18%. But then when you look at all of the fees involved, it comes out to 25%, right? And that's, that's expensive money. That's expensive money. So for a private equity investor who's not spending all of this money to find, new projects and negotiate deals, you don't have infrastructure or staff, you're just doing it on your own, you very well might be able to trip across one of these quote unquote distressed assets, offer up some of your money in a senior position. It could be first money out, and you could easily beat out the rest of the market at 12.5 to 15%. Boom, the movie's yours. You're in a first position above everything else, and you can put in stipulations saying like, I'm giving you this money, but you're not allowed to sign any additional funds above that mark. Of course, you got to do your due diligence, because if you put in, let's say, $250,000 in a senior position on a picture, and they say, yeah, we're going to finish the movie for $250,000. If you don't know how to analyze what their expenses are, and they spend your $250,000, and now all of a sudden they need another $100,000, either you're on the hook or somebody else is on the hook. So you need to know what you're doing, and if you don't know what you're doing, hire somebody. And I'm not the guy. If they're in post-production, hire somebody who does post-production. Hire, we do a lot of business with Periscope Post and Audio out of Chicago. They do a lot of fantastic work. Hire them. Hire Tunnel Post. I know them. My first trip to Sundance Film Festival was when I was in my 20s. I mean, it was a road trip with Luke. These are good companies, and if you hire them and you pay them a little something, they'll tell you like, yes, this is a safe investment. We can take everything that this filmmaker has, we can get it through post-production, and we can deliver it, including E&O insurance, and you're going to have a delivered product. Well, then you're in a pretty good position. So I guess to summarize, post-COVID investments, the same as before. Don't make any mistakes. Look for the solid genres that are selling. Look for the solid name talent that are selling. We're not just post-COVID. We are current on the war going on between Netflix and Amazon, not just here domestically in North America, but around the world. And so those companies are really putting a squeeze on a lot of foreign buyers. So as an investor, whether this is your day job investing in feature films or it's something that you just are doing on the side, and I get it, be careful and don't treat the post-COVID world any differently than you would the pre-COVID world. This is not the stock market. It's quite a bit different. Anyways, I'm gonna get back to Los Angeles. I don't know how I feel about that. There's guitars here. Oh look, there's a tree. Is everybody good? All right. As always, I sign off. Aloha.